Okay, chapter 21, video 2. Just a reminder, do study this chart. I will test on it. Making assumptions in the cost volume. So management uses this a lot for what's called what if, the what if scenario. What if we do this? What if we do that? How will it affect us? And so this is used extensively by those companies who understand this concept. Again, you're going to work within a relevant range where the relationships are more predictable. I guess they say linear, I say more relevant. So unit selling price remains constant, the variable costs, and so these are the variables that you're going to start changing. What if we do increase our price? What if we do add a new piece of equipment and it lowers our variable costs and so forth like that? So working with changes, again, you're going to change one aspect, do a what if, change another one, do another what if, and it's used extensively for pricing. If we change our pricing, obviously it's going to change our contribution margin and our volume requirements. And of course there's a philosophical aspect to the company. Are we a high cost producer, low cost producer, or volume producer? So it fits with it has to work within their marketing scheme also. So again, they'll put in some other variables like maybe income tax, pre-tax, and so forth. And so again, they're just going to go through a couple slides here showing you what happens if they change this variable or that variable. Computing sales for target income. So it can be adjusted to so if you want to show if I need to make a certain amount of money, like maybe let's put in who wants to break even, let's at least try to get a 20% return on our product. So you can adjust it for that. And so you're going to take away the taxes. Again, you can do it both by unit or volume units or in sales dollars. There's different ways to do that. I mean, it's the same way actually. You're just converting one either into a volume of units versus maybe dollars you need to make. Again, they're just going to give you through a couple examples on this. I don't think I need to beat this up. You can follow this through reading it and taking your time on that. Again, they're doing it by units. Here they're doing it by dollars. Computing the margin of safety is an important concept too. And it's what the margin of safety is the amount that sales can drop before the company incurs a loss. And so what they're saying is if we're projecting a 20% profit margin, then maybe our margin of safety might be expressed as a percentage of expected sales or how many units, because they always want to know their break-even point. But then they also have their projected, and the difference between the break-even and the projected is that margin of safety. Sensitivity analysis, what happens if we changed our fixed costs, what happens if we change our variable costs, and so forth. And this, again, is another way of doing what is called the what-if scenario. Now, you can also use this for computing a multi-product break-even point. Many companies don't sell one product. They might sell, maybe, for instance, different sizes of the same product, or they have some other features, to a product. So there can be a range within maybe one core product. So now you're dealing with a composite unit. I'm not going to test this as much. I want you to understand the basics of break-even analysis. This is where you're getting specific to a company, and that's when you'll go back and research this method. But I do want you to understand pretty thoroughly the concept of break-even. So I have put this into the homework. I will not put this into the test on a break-even point for multi-product. And it's going to give you some variations, and there is a term here that I don't think the book covers that you should use, and that's called cannibalization. So let's say here they're giving an example of haircuts. You have a basic haircut of Ultra, then a budget, and you can see the different prices. And you can see the unit contribution. Well, obviously you want to sell more of the Ultra right? Because it's contributing a lot more. And believe it or not, the budget does better than the basic here. So this tells you a little bit about maybe sales volumes and so forth. But the concept of cannibalization is, if I offer a budget and ultra, how much of the ultra will drop down to the budget? That means the budget is cannibalizing the ultra, or vice versa. That's going to be an estimate. You have to estimate that when you're looking at multi-break-even points, but it's called cannibalization. Again, they're just looking at some contribution on a composite basis. I'll let you do this through the homework. Again, I'm not going to focus on this one. And global view. I'm not going to, again, focus on global view. This is used internationally, obviously. This is a standard business analysis here. Another important concept is operating leverage. So you'll hear a company is how leveraged is the company. And there's two types of leverage. One is financial leverage, and the other one is operating leverage. And operating leverage is the measure to the extent to which fixed costs are being used in an organization. Because again, those fixed costs, you get as your volume increases, then it's divided into that fixed cost, and it drops your fixed costs on a percentage basis as your volume increases, and so you get more leverage. And so this is what they're looking at here as from an operating leverage. And the book doesn't talk about the financial leverage, but basically it's the same concept. As to what extent have you used debt, which is a fixed cost. You know the cost of your debt over a period of time, and that debt can then increase your financial performance if you can make more than the cost of that money. So that would be financial leverage. But they're both tied to the same concept, and you're fixing these costs. And they're going to give you some mathematical formula here. That's it for this chapter, and we'll start in chapter 22 next.